Investors and traders, welcome to the channel Market Chart Pattern. Today is 2nd of July 2023. It is the start of the second half of the year. It is also a start of the new quarter, and unbelievable, but we finished first half of the year. So 2023, we are halfway through. In this video, we are going to take a look at the Treasury bond futures market for the United States. So we will be taking a look at the long bond, which is the 30-year T-bond futures. We will also take a look at the 10-year Treasury note, and we will look at what sort of pattern formation we are getting and what the price is likely to do. This video is for educational purposes only, and it is not a financial advice. So the reason we are taking a look at the T-bond or the futures market for the bonds and treasuries is because it is a big chart or a flow chart of cash. So the money moves out of one thing and it goes into another asset class. So we really need to look at different asset classes, particularly the bonds and also the equity markets, so the indices, and try to understand how these markets are actually interrelated, or in terms of what sort of information they are giving us. So the bond market happens to be a much larger market than the equities market, and it is also a market which is much more sensitive to the interest rates. So they are able to actually forecast in some cases what the market is expecting in terms of the interest rates prevailing, and perhaps also in the future. So that's why we really need to also pay attention to the bond markets, and once a week we will be covering the bond markets for the futures market for the United States. So this video is for educational purposes only and is not a financial advice. What we are looking at is the daily chart of the T-bond futures. It's also called the long bond because it is a 30-year duration bond, and it's a futures contract for that. And what we have going on here is actually we have this bearish asymmetry which is still in place. Watchers or the subscribers of the Market Chart Pattern channel will know that we really like to take a look at the concept of market asymmetry, because the markets like to repeat over and over again. And what we are looking at is, just to recap, basically we have had rallies in the past in this market. So this market has been going down for a very long time, in fact. So just I'm trying to squeeze this chart. In fact, it was around this COVID time on 9th of March 2020 when we had the peak. And during this time, if you could remember the rhetoric was that there's a possibility the United States might actually also go into the negative rates, although the chairman of Federal Reserve, Powell, he mentioned that he did not believe in negative rates situation. And look what the market has done. It has done totally opposite of what was the rhetoric was back then. So the rates have gone up a lot ever since, and look, it's been just going down, 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 and every time there has been a rally of about this much, and it has failed. The price has failed to move higher. So what we are seeing now is actually basically this is what we call a bearish asymmetry, and we have had this failure in price to move higher every time this magnitude has been reached in terms of price moving higher or the yields moving lower, because in bonds they move inversely. The pattern formation that we are looking at in shorter term is this yellow shaded area, and we were watching for this 127 level really carefully, because it was this 61.8% Fibonacci retracement, and also there was a 1-to-1 projection ABCD. However, the price went lower and it went and touched the 125 level, which is 78.6% Fibonacci retracement. And ever since that, the market has actually tried to rally a little bit, and it's just gone sideways to downward now, and it's coming down to touch this again. It looks like the interest rates are likely to go higher. This seems to be the message that we are getting, at least from the longer end duration on the yield curve. Looking at the bond futures chart, it has also broken this line, although we like to give more data or more time, so we need to see a few more closes below this, and in fact convincing closing basis of at least 2 consecutive days below the 125 level, because that's going to be the 78.6% Fibonacci retracement. Moving on to the weekly chart, what we can see is that this market is forming kind of McDonald's arch pattern. So I would just give it a name, McDonald's pattern. It's an M sort of pattern formation, and it looks like the market has gone in some sort of distribution after trying to rally here. And also if we just draw a trend line here, and what we can see is that it's just right at this trend line, and 125 level is going to be the really key level for it. If it is gonna break to the downside, then we are looking at higher rates and lower prices, and this 117 or 118 level could also be retested. So this is the picture that we are getting from the 30-year bond futures, and what it's telling us that the interest rates are likely to go higher. Let's take a look at the 10-year T-note futures. Similar thing, we still have the concept of bearish symmetry in this market as well. This is highlighted by these blue lines here. I'm not going to go into the full detail of it. This market has also been selling, which means that the interest rates are moving, the rates are moving higher and the price is moving lower. What this market has done is key level of 111, or roughly we can say 112. That is the 78.6% Fibonacci retracement. It has tried to rally off it once, and now it's coming and retesting it. And then we also have this rising trend line here. So we need to pay close attention next week what this market is going to do. If it is going to break these levels, at least on 2 consecutive daily basis, then we are looking at a lower price, higher yield, so interest rates going up. And then there's a possibility that the lows of last year could also get tested. Now what it also means is that if the bond market is telling us that the interest rates could be going higher, it also is likely going to have an impact on the equity markets, especially the kind of companies which are in the growth sector and need quite a lot of cash for their operation. Their liabilities just to service the debt is likely to go higher because of the higher interest rates, and that could have an impact on the prices. So the tech sector once again could be something which could get more impact than some of the more established names, which could be in some sort of traditional sectors. So that we'll cover in another video when we take a look at the US stock indices, the next video that I will do. So for now, this is what we are looking at, and this is the message that we're getting, that these two markets are trading at some really critical levels. If these levels are held, that's going to be good. What it would mean is that the price then probably move higher and the rates come down. However, if these levels get broken to the downside, it means that the rates are likely to go higher as the price moves down, and that could have an impact on other markets, as the bond markets are much more sensitive to the interest rate movement. So this is what we are looking at, and thank you for watching the video. And if you like our analysis, then please do subscribe to the channel. If you found the video of educational value, then please do subscribe to the channel and also hit that like button. It just gives me an indication that people find the videos of educational value, and an encouragement for me to keep on making more videos for you guys for educational purposes. Thank you very much. Good luck and good trading.